to be joined by Andreas. And Andreas, thank you so much for taking the time.
Thank you for having me.
If you go all the way back, do you remember your first memory about finance growing up?
Well, I think the first clear memory I have from the financial world was participating in a fictional equity game when I was probably maybe, I don't know, 10, 11, 12, something like that. My dad was employed at SE Banken's asset management at the time, so he sneaked me into that internal game that they had. I'm not even sure that it's compliant anymore to have such an internal game in the fictional equity game from the Danish newspaper Børsen, but at that time it was. I participated in that game and actually won it against all of these portfolio managers, even if I was 10 or 11 at the time. And I recall betting on a couple of Danish shipping companies in this equity game, DS Norden and DS Torm. And I'm not even sure that I was aware of how, when, and why a shipping company would perform or anything like that on the stock exchange. So I mean, it was pure luck. But I held these two equities and basically just beat the hell out of everyone in this game. So that was a pretty fun experience, and I think that gave me a taste of the real life in finance. And then second thing that I really recall was I think it was in ninth grade. I wrote an article in history on pros and cons of having a fixed exchange rate regime in Denmark. Pretty nerdy stuff, given that was in ninth grade. But I think my dad convinced me of doing so. So those are the sort of the two clearest memories I have from my childhood, and it got me started in a sense.
But tell me a bit about that influence from your father then, because that has to be instrumental growing up then.
Yeah, to a certain extent. I mean, he worked as in SE Banken's asset management at the time, but he also, prior to that, worked as a chief economist in various Danish banks. So of course he always wanted to discuss markets, the economy when he got home. And slowly but surely, I started to get to a point where I could also challenge what he said. In the beginning, it was one-way traffic, I guess. And nowadays, we simply don't disagree on anything at all. I think my dad considers me like the perfect reverse indicator, and I do so with him as well. So for now, we cannot agree on anything, but I guess it also shows that sort of two different generations of economists can end up working in very different ways, because we have kind of similar backgrounds, at least from the university side. But nowadays we have two very different approaches to investing and all that stuff.
But before deciding to pursue a career in finance, did you explore any other option, or was it like crystal clear from the beginning that you wanted to pursue finance?
I guess more or less. I never really paused in my travel towards ending up where I am right now in Nordea. I studied a master's in finance, so pretty straightforward choice if you want to work in financial markets. Already in high school and before that, I already started exploring equity markets. I already started exploring how to invest myself. I explored various news sources and all that stuff. So it's been pretty straightforward for me. It basically always caught my attention how financial markets reacted to the real world.
So what made you ended up in Nordea? What was the journey to get there?
It was actually a bit of a coincidence that I ended up at Nordea, but I found out that Nordea had a team called Alpha Strategy. So it was a team designed to come up with what you call alpha strategies. So basically financial investment models trying to deliver a alpha return in financial markets. And then I joined that team as a very junior. I was still a student at the time, and it was a really good school for me, since they had a view across asset classes. So I was actually brought up both looking at equities, foreign exchange, fixed income, and to a certain extent also even non-liquid asset classes. So to me, it was sort of the perfect schooling. The team doesn't exist any longer, but at that time it was a pretty big team here in Nordea, and the perfect school since it was so cross-asset.
And talk a bit about the position you have today, and how do you typically structure a perfect workday?
Right now, I have a position where I look at global markets, basically. So I'm not too focused on Scandinavia. We have Scandinavian specialists in each of the countries. I look a bit at Danish markets since I sit here, but otherwise I'm mostly focused on the rest of the world. And right now I am part of a 3 to 4 man team forming Nordea's cross-asset views towards institutional clients. So I mainly speak to pension funds, hedge funds, central banks, and those kind of clients of Nordea, and talk about how to allocate across assets and across geographies. So how to structure a day in this kind of role, it's actually very tricky to say. I would almost go as far as saying as that I have no structure at all, since I'm sort of on the sell side of the equation. I speak to portfolio managers, so people taking investment decisions in various institutions. Then I'm very dictated by the relevant themes for investment professionals, and I'm also very dictated by the news flow and by various events. So it is very tricky to structure it in a specific way. I guess I'm very reliant on what happens in the market, and the funny thing is actually that when markets move a lot, then I'm usually very busy commenting on that, but I don't necessarily have a lot of talking points to clients on such days, since they're very busy sort of maneuvering the moves in financial markets on those days as well, while I usually have sort of a much more scheduled day with client meetings and client interceptions on days that are more calm in financial markets, because that's basically when you have the time to sort of try and debate what would be the next theme for financial markets. How should you position yourself in investment wise for the next potential big drivers? So it's a bit upside down for me. It's actually more calm when markets are very violent, and vice versa for me.
But how do you prefer to learn and sort of understand the financial markets? Do you prefer to have sort of time to do deep work, to sit still, to read a lot of papers, to do research, or do you prefer to interact with a lot of other smart people to bounce off ideas, etc.?
I tend to think that I learn the most by talking to clever investment professionals as much as possible. So I try to have at least a couple of hundred client meetings a year, which is quite a lot. And usually you get a good sense of the big drivers of financial markets when you talk to a lot of investment professionals during a week, for example. You gather a lot of information on how various topics are perceived by investment professionals, and you gather a lot of information on the actual positioning in markets. For example, are people upbeat about the expectations, or are people downbeat? That's really much easier to figure that out when you talk to a lot of people actually taking the investment decisions. But of course, if I want to become a subject matter expert within a niche, and I think that's really a key thing to focus on, how to be that, then you need to set time aside to figure something out that no one else is able to. I tend to think that if something is very straightforward to understand, then there is absolutely no chance of you having an edge on that topic, since it is fairly easy, understandable for everyone. While if you dig into a topic for financial markets that is much more incomprehensible, then there is actually a possibility of you gaining a knowledge that could get you an edge on financial markets. So that's always something to bear in mind when you study financial markets, in particular when you do it professionally, that you need to look for niches. because the markets that are the most covered, they are very tricky to get an edge on.
I mean, that's a super interesting insight. And talking about one of those topics, I mean, what got you so interested in foreign exchanges in the first place?
It's I think that I consider foreign exchange more based on fundamentals than other asset classes. It may be a bit of a bold statement, but there's a very clear line of events from politics to central banks to foreign exchange, and you can see the reaction immediately. So it gives you a chance to talk about everything when you look at foreign exchange markets. That's also intriguing. It's probably the market that is driven by the biggest pamphlet of variables, while equity markets and also to a certain extent fixed income markets, they are a bit more univariate in terms of which variables actually drive the price action. So the foreign exchange market is also the market where you can come up with the most bizarre investment ideas. And given that I tend to have a bit of a weird brain, then I kind of like that.
But how early did you get interested in foreign exchange? Was it pretty early as well?
Yeah, I actually think so. I mean, already in the ninth grade, I wrote about the pros and cons of having a fixed exchange rate regime. So it was early, and I figured out that a lot of the smart hedge funds in the world, they exploited the foreign exchange market. In a sense, it's pretty interesting if you're actually able to create persisting returns in FX, since it is a zero-sum game, right? There's always a winner and a loser in the sense in an FX market, and I find that very intellectually stimulating. That if you manage to create a persistent return, then you have something really smart going on for you.
Definitely. I wanted to try to start sort of from the first principle and talking a bit about currency. So in your mind, what characterizes typically a strong currency in your mind?
Well, first of all, if you want to find a strong currency, you need to look at the fundamentals of it being a reserve currency in various central banks across the globe. I think the reason why the dollar is so strong right now in a historical perspective is that it's still the reserve currency number one worldwide. And what's needed to become a strong reserve currency? Well, you need a strong and liquid bond market that you can invest in. That's very important. Then you need to be an exchange between people. So if you look at the dollar, it's used for exchange. It's used for exchange in commodities. It's used for exchange in various financial instruments, and that's why it holds such value compared to other currencies. So those are sort of the very fundamental and long-term structural trends to watch for currencies, whether they hold these characteristics, whether they are obvious choices in FX reserve for a central bank. If you look at it more tactically, then it obviously matters for a currency whether the underlying central bank is hiking interest rates or the opposite. So there's a lot of analysis on central banks in my everyday life, given that they are such an instrumental driver of the actual exchange rate development on a more short-term horizon. So those are sort of the key characteristics I'm watching out for. Where's the central bank headed? And on a structural basis, is this a currency that is used for exchange of goods or assets? And is it a currency that could be an increasing part of FX reserves globally going forward?
How does that argument look on the other side if you're looking for very weak currencies? Do you flip the argument on the other side, or are there other variables to consider?
Yeah, well, you would certainly flip the argument on the other side, but there is also one variable that is absolutely instrumental in terms of pointing out weaknesses in currencies, and that's predictability. And by predictability, I mostly refer to political stability. Uh, Worst case example right now is the Turkish lira. You have a central bank that is 100% without independence. Every time they take a decision that Recep Erdogan doesn't like, then he lays off the president of the central bank. He's done so, I think it's 4 or 5 times within the last year. And every time the market reaction is super clear. The market simply dislikes the Turkish lira as a result of this. At some point, I guess the market can end up educating Erdogan on this, but he hasn't reached that conclusion yet. So that's one focal point to watch out for: political stability and independence of the local central bank, focal points for currency.
Makes sense. So we got some Twitter questions, and I think it's good to take them now. So one was about the Norwegian kroner, the multi-year weakness. What are your thoughts on that one?
Well, it is a bit of a puzzle, because fundamentally Norway is in such a good state. But I think the interesting correlation now for the Norwegian krone is the one versus international equities. Since the Norwegian oil fund is now, I think it's roughly 3 times as big as the Norwegian gross domestic product per year, then the investment decisions by the oil fund will carry a lot of repercussions for the Norwegian krone development. And since Norway is, well, basically the biggest trust fund worldwide by now, then it matters a whole lot for the Norwegian krone whether equities gain or lose. So the Norwegian kroner is more or less an equity game by now. And then I think there is another overlooked angle to it, which is the ESG angle. Obviously, since Norway is so oil heavy, then I would argue that it's a feasible thesis that the Norwegian krone has been weakened as a result of foreigners exiting positions in Norway due to ESG reasons. Some of my colleagues in Norway have also spoken about this topic, but it is a tricky one to truly prove. But it makes a whole lot of sense given the amount of focus that institutional investors have on the ESG component right now.
Totally. So another one was the interest rates in Denmark versus Norway, and how negative interest rates have changed the financial environment.
Well, yes, I am basically sitting in the epicenter of negative interest rates in Denmark, and we've struggled with those for quite a few years after all. I think the most interesting thing that you can point out in terms of negative interest rates, and that's basically both the case in Denmark and in Germany, is that you've seen savings going up as a result of negative interest rates. So if you're a simple saver and you are faced with a negative interest rate, then you, on average, actually decide to increase your savings simply due to the fact that you have a negative return on them. And that's completely upside down from the thesis of the local central banks. The whole point of going to negative on interest rates is obviously that it should spur some economic activity. But if you just start saving even more as a consequence of it, then obviously you don't get that reaction in the economy. We have a super interesting lab in Sweden. They went from substantially negative interest rates to zero over the course of the past 2 years. And I would argue that it's completely impossible to see any negative side effects in the Swedish economy of those 2 interest rate hikes, which should work as a signal for the European Central Bank. The Danish Central Bank is obviously not completely in charge of the monetary policy since we have an exchange rate peg against the euro. But the European Central Bank at least should watch what's going on in Sweden, since we don't really see any negative side effects of those 2 interest rate hikes back to zero from minus rates.
But why do you think that thesis doesn't work in Denmark?
Well, I mean, in Denmark, we are obviously relying on what's going on in Frankfurt due to the exchange rate peg. So we cannot decide to have a completely different interest rate compared to the Eurozone, since it would lead to a breakup of that Euro peg. So that won't happen. At least it's a political decision, and there is basically no debate on it. So in terms of the European Central Bank, they are slowly but surely starting to debate negative interest rates and repercussions of it. But I'm not sure that they're anywhere close to actually following the Swedish example of going back to zero. And I think the reason is that they fear that the euro would gain strength against a lot of currencies worldwide if they hiked interest rates back to zero. And we know that there is at least one Southern European economy that would basically fall into pieces if the euro gained too much, and that's Italy. So everything that is done in Frankfurt by the European Central Bank has to take into account that Italy is a very fragile element of the Eurozone. And I think that's the exact reason why they don't even dare to debate interest rate hikes.
In the macro sense, in 2021, what has been sort of the biggest surprises for you that you didn't see coming?
Well, first of all, if I look back on the past 12 months, then I think it's a perfect example of the world being upside down, in the sense that the equity market is actually leading the real economy and not vice versa. I mean, I was basically brought up with the thesis that the economy decided the fate of equities. But nowadays, it's fairly clear that equities move ahead of the actual economy. So to me, the most surprising element was how quickly equities recovered from the COVID crisis. You could almost argue that the equity market predicted the lockdowns, since we had a marked reaction even before the lockdown started, maybe just a week ahead of it, but they predicted them. So in that sense, I really find it intriguing to figure out how to forecast equities when you cannot forecast equities by using economic variables, or you cannot use stuff that you usually used. So you need to be much more focused on high frequent data to figure out what's going on in financial markets today than just 5-6 years back.
Interesting. So looking forward, I mean, it would be great to have some predictions. I mean, you were extremely bullish on gold. Can you tell us that argument and how you were thinking about that?
Well, the reason why I like gold is that it's a decent hedge against inflation. And I'm not sure that anyone really dares to think of a complete regime shift on inflation. But I think that there is a scope for a very different inflationary environment over the next couple of decades compared to what we've seen over the past decade. The reason being that politicians and central bankers, they always calibrate the response to a crisis based on the most recent crisis that they have experienced. And this time they calibrate the response to the COVID crisis based on the lessons learned from the great financial crisis in 2008, 2009. What happened in 2008, 2009 in hindsight was that we had a massive demand crisis. So there was no trust in the economy, and there was no trust between financial intermediaries, which led to a massive demand crisis. The COVID crisis is not a demand crisis. I think we have fairly sound evidence of that now. Just look at real estate markets in each of the capitals in the Nordics, for example. There is no whatsoever demand crisis. And what you've done over the past 12 months here is that you've basically added fuel to the demand fire each and every month via a big fiscal stimulus and via monetary stimulus. And I think that's pretty interesting, given that this is mostly a supply shock. This is not a demand crisis. So this is a supply-driven crisis, since it was basically impossible to to supply the economy with the amount of goods and services that were needed through Q2 last year and also parts of Q4. But there's no demand crisis, and we are acting as if this is a demand crisis. So I think we will overheat basically right about everything.
How high do you think inflation can go? How do you think inflation can go going forward?
Well, and I would not be surprised to see double-digit inflation in the U.S. this year. The U.S. is clearly the worst example here because they run a deficit of almost 20% of GDP. You've never ever seen that outside of war times. Even if the U.S. is at war quite often, then they usually don't run deficits like this. I think we have a couple of observations that were worse during the Second World War, but this is completely out of league with anything we see during normalized times. And honestly, I don't really see the scope for it. It doesn't make too much sense given that there is no clear demand crisis. So the US is the worst example here, and I would expect double-digit inflation this year. On a more structural basis, then I would argue that inflation will probably move 1 to 1.5 percentage points higher than what we've seen in the past decade. Is that much? Well, it does matter. It does matter for interest rates, and it does matter for financial markets in general. I think there is a bigger risk of a regime shift in an upwards direction for inflation than basically, it is the biggest risk I've experienced in my adulthood. And it feels kind of weird to talk about inflation for me because I've basically never experienced it. And there's a bit of cry wolf over this debate since a lot of economists have been scared of it over and over. But I've never ever raised the flag before now. So I really, for once, see the scope for it, since we calibrate the crisis response as if this was a demand crisis, but it's not.
Another concept I wanted to talk to you about was also the universal basic income and the role you think that will play going forward in the financial system.
Yeah. I mean, I tend to think that we have already slowly but surely sneaked universal basic income in via the back door in the US. The direct transfers that we see from the Biden administration, but that we also saw from the Trump administration, is a sort of de facto temporary universal basic income. The interesting thing is whether it's possible to roll such temporary programs back again. I find that much trickier than widely anticipated. We have a couple of temporary programs still in place after 4 decades in Denmark, just to give you an example of it. So it is much trickier to roll back free money once you've implemented them, in particular in a democracy. And thankfully, we have democracies across the Western world, but it's very tricky to roll back such temporary relief setups. And if we assume that some sort of universal basic income will be implemented in many Western countries over time, over the next decade, then I would argue that it's the most inflationary signal that we've seen for the economy in many decades, since it puts the workers in a much better negotiation spot than what they've been in decades. If you look at wage increases in the bottom of the labor market, they haven't been material for decades, and that's clearly mostly a US phenomenon, but also present in parts of Europe. And if you implement universal basic income, if you introduce that, then you will put them in a much better negotiation spot. And then obviously it wouldn't be a super strong signal for equity structurally if it were to happen.
But given that you're arguing that it's very tricky to roll back, you think that is here to stay and it's going to take part of the new financial structure?
It certainly in the US, yes. I think it's here to stay in one way or the other. In Europe, we haven't moved as close to it yet, so maybe we will not see it implemented in Europe until the next crisis hit. But as soon as you introduce this as a crisis measure, then it's at least a part of the toolbox every time there is a crisis. And let's assume that the economy takes a hit when you decide to withdraw this kind of stimulus from the economy. That wouldn't be too big of a surprise to me, that you start to see a slowing momentum as soon as you start trying to withdraw parts of the crisis tools. Then it's basically first at hand if you want to introduce a new set of stimulus measures to re-increase the momentum in the economy. So I think we're slowly but surely getting there. And there are also good effects of it, but side effects for financial markets are not necessarily super bullish for savers.
I want to switch gear a bit and talk about art, because you have invested in an art company. Can you tell us
Yeah.
a bit about that interest? Is it an interest in art, or was it just like a great company that you wanted to invest in?
Well, I have invested in a company called Splish. So it's a small online art gallery, but we're trying to move towards being a highly technological auction house. And the point being that millennials, to a much larger extent than former generations, they're much more inclined to buy online. That's an easy check mark to make, but they also have a different view on experts. So a lot of expensive art right now is in the hands of experts, but the millennial generation, they are much more inclined to look into other sorts of expertise, and I think the current set of market players are completely unaware of this tendency. You can just see it from how millennials tend to trade financial assets as well. They wouldn't necessarily call the bank in the same way our parents would have done, right? To get a tip on equities. They go to Reddit instead. And I expect something similar to happen in the space of art. And we're trying to front run that via this new company.
But how did you get involved in that company? Was it coincidence, or did someone you know?
Yeah, I actually bought something from the platform, and I really liked the way that they presented it. I almost never go to a shop anymore, and I tend to like to find my expert information myself instead of meeting people in real life when I look for expertise on products. So I bought a piece of art from this company, and then I got involved. So I took a meeting with them afterwards. They wanted to hear why I bought it and all that stuff, and then we got the conversation going.
In the future, would you like to get involved in more investments, or is this a one-off that you would like to do beside job?
Well, it's tricky to say. I mean, I certainly like the idea of seed funding startups, but I also need to find a balance. It's a fine balance act whether I have the time to involve myself in more. I'm currently a very passive investor in Splish, so I don't spend a lot of hours on the company, and whether I take on new investments such as this one, I think it's tricky to say. If the right opportunity is there, for sure. I really find it intriguing so far, the investment I've done in this company.
Sounds super interesting. Before going on, we talked a bit about talking about some of the favorite books you read. Do you have any recommendations for people?
I have a few boring ones initially. I think it's a very good idea, no matter whether you have a true interest in central banks or not, to read at least one book or one biography from a central bank chief or former chief of a central bank. My personal favorite is probably Paul Volcker's book. So he was in charge of the Fed during the period of very high inflation. As far as I remember, it's called The Quest for Sound Money and Sound Government, something like that. And the interesting thing about reading the thoughts of a former central bank boss is that you get a good insight to how they think. And it's maybe one of the very few important inputs to financial markets that will not be automized anytime soon or automated, right? So you will still have regular people taking decisions with a lot of repercussions for all financial assets in central banks, as far as I can see in the coming decades as well. So you simply need to figure out how these people think, to have an edge on their decision making. So that's one clear recommendation. Read something from a former chief of a central bank, and then I also really like the book Black Swan by Nassim Taleb. He's, by the way, a professional douchebag. If you follow him on Twitter, he's so rude against everyone trying to ask him questions, but his book is pretty good. So the book is called Black Swan, and it's of course a book about black swan events. It's I actually think he invented the title himself, or the phrase himself. These unpredictable events that carry a lot of repercussions for financial markets, but also society in general. And the very interesting thing that you learn from the book, also back to my point on the COVID-19 crisis response being calibrated by the great financial crisis response, is that most people tend to have a very simple ex-post analysis of black swan events, such as the great financial crisis. It's probably not a textbook black swan event, but even years and decades after, we have very simple explanations for extremely incomprehensible events such as the great financial crisis, and the lessons that we learn are very, very simple, and that you will get a lot of examples on why that is in Nassim's book Black Swan. So read it just because of that.
That's two very good ones. Just in terms of your own reading habits, how much do you read for yourself?
Well, I tend to read quite a lot, but I usually don't spend too much time reading what Donald Trump would call mainstream media, not because I hate them, but because it's very rare that I find new information, given that I follow things in economy and business so closely. So I basically spent the most time watching Real Vision. So this is I guess we'll call it a video media, with daily interviews with experts in various topics, and I tend to like that kind of format more. I like to listen and I like to watch more than read. Then it's easier for me to get a lot of information in a short time span. So Real Vision is also a great recommendation from here, and I don't hold any equity in the company. So
no, but I mean, you've done many great interviews there. So I mean, it's a super high quality media company. So just a last question before we wrap up. So just some final advice for people that are starting to pursue a career in finance. I think one thing you touched upon earlier in the podcast was that ability to find that niche and to be really good at that. Maybe you can expand that concept, and if there are other advice, that would be great as well. But I think that one is a very good one.
Well, if you're pursuing a career in finance, whether it's on the sell side in the bank or in a portfolio manager's position on the buy side of the equation, then I would recommend you to be extremely focused. Since being a specialist is what really gets you going in a financial career. Don't expect that you are able to get an edge on the broad market, but you are able to get an edge on a very specific niche of the market. That's possible if you work enough. So that's something to really bear in mind. Focus, and don't expect to be able to beat the market in all asset classes. My own niche, if I should put it like that, is that I've done research on central bank liquidity to a very, very large extent. So I consider myself subject matter expert on central bank liquidity and how that filters into various asset classes. And it's a theme that has grown in importance over the past 5-6 years since these quantitative easing programs from central banks are of such importance to developments across financial markets. So that's one thing to really bear in mind. If you want to pursue a career as a strategist or as an economist in a bank, then I cannot stress enough how important it is to say something that is just a bit out of line with what everybody else says. I truly try to ask myself that question every time I write something or every time I do an interview. Is this something that everybody else is already saying? Then why should I spend time on saying it? So find something that is not already a consensus and focus on that. And that's also why I don't spend too much time reading Financial Times, The Economist, and stuff like that, because it is just one big consensus story that you get from such news outlets. Not that there is anything wrong with that, but it doesn't give you an edge on anything. And finally, if you're starting to consider investing, also here, focus on a niche and don't be too active. I've never ever seen anyone trying to invest fundamentally having success being extremely active. If you want to be extremely active, then you need to look at high frequency strategies, and basically those strategies are not fundamental. They're based on whether you're faster than your peers or not, and that's a technological battle, not a fundamental macro battle.
That's a perfect ending, Andreas. Thank you so much for taking the time. It's awesome.
Thank you. It was a pleasure.
Hi everyone, Christopher here again. Just a few things before you leave the show. If you like this episode, it would be great if you could give it a review and also share it with your professional network. If you want to get in touch with me, Twitter is the place. Just go to @ChrisVonheim. You can also find this information in the show notes. Hope to see you tune in to the next episode and take care.